Welcome back. In our final segment today, we discuss the recent performance of the Colombo Stock Exchange, which had to withstand some gut-wrenching trading days, in particular losing some 44 billion rupees in a single day in January. And in volatile times such as these, how should investors go about selecting the best possible stocks to invest in? Benchmark's Anushan Selvaraja attempts to shed some light on these issues.
Welcome to the Voice of Business. Joining me on the show this week is market analyst and LMD columnist Hasita Premaratna. Now Hasita, what is going on? There seems to be little or no respite at the bourse these days.
Yeah, I think market came down in the first month, particularly in the month of January 2012 with the previous trend that was going on, and with the global crisis also giving a lot of uncertainties to the investors. But beyond that, I think in the month of February we had another maybe a 300-400 point drop in the index within about a few days, mainly due to the fact that there was a bit of turmoil in the foreign exchange market. So when the rupee slipped and rupee was kind of free floated once again, and it kind of gave a lot of uncertainty to the investors in terms of how and where the rupee would settle down, and as a result what would be the impact on the broader economy as well as the corporate earnings. So in that backdrop, I think the investors got a bit jittery, but I think things have settled down a little bit from there, but still the uncertainty is likely to continue, and the volatility in the indices will also continue to be there.
The ASPI fell about 562 points or 8.5%, now following the 2 consecutive years of strong returns since the end of the war in 2009. Now what in your opinion have been the main reasons for this downfall?
Yeah, I think there have been a multiple set of factors that have contributed. If you look at 2011, the market was about 17% up within 2 months by February 2011, and thereafter the slide started to come. There were multiple reasons. First of all, I think there was a bit of uncertainty on how the credit system would work, and the regulators brought in certain credit control or restriction rules which had an impact on the investors' mind, and as a result on the overall performance of the market. Secondly, we saw once that was kind of getting some kind of a settlement, we saw how the global situation getting into a bad shape, and by about August 2011 there was a lot of difficulties in the global markets, which was also reflected in the Sri Lankan market as well, and thereafter the battle between the regulator and certain powerful investors continued. Again, was not a very good sentiment to the overall market condition. So that towards the latter part of 2011 had an adverse impact and a negative sentiment towards the overall situation. Post-budget, again we had certain negatives coming through, particularly the 3% appreciation that happened during the budget speech, which also was seen as a negative situation from the investors' point of view. So all these factors put together I think contributed towards the downfall in 2011 market index, and then the same trend, adverse trend, continued to 2012 as well.
Now how should investors go about selecting the best possible stocks to invest in these volatile times?
What is important at this time is to reassess the portfolio, and particularly the good fundamentally strong stocks are now kind of available at low price earnings multiples, maybe in the range of 5 to 7 times, 5 to 8 times type of range. So if you look at some of the stocks which have reached very high price levels, have but fallen down in the recent past and have strong fundamental backing. I mean, earnings are strong asset base, growth potential is high, trading at about 5 to 8 times multiple. You can pick up a bunch of stocks, I think, to look at value. That's one side. The other side is there are certain good dividend paying stocks. We call them defensive stocks. Things like maybe Caltex, things like maybe CTC, I think those have slightly moved up in price despite all these hiccups in the scenario, and either they have not really come down with the market. So those type of stocks, if they come down a little more and there is opportunity to pick up, I think those good dividend paying stocks are also companies that investors should be looking, because it's always good to have a portfolio in a volatile market to pick up the stocks. And also I think it's important that the investors have a bit of cash in hand, because the volatile times are still not over. So you should not really go and jump in and get a big portfolio of stocks, but maybe you need to be at least 50, 60, 70% in cash and be ready to exploit different opportunities that may come. And I think it should always be a gradual pickup of stocks, not just to jump in and pick up large quantities of stocks at this point of time. But obviously, volatility gives opportunities for people to trade and make certain short-term trading profits. But more than that, I believe that when the markets are down, when the sentiment is negative, investors should really look at picking up and accumulating good, fundamentally sound stocks.
That was LMD columnist Hasitha Premaratne in conversation with Benchmark's Anushan Selvaraja. That concludes this edition of Benchmark. We'll be back again with you next week at the same time.